Bitcoin, the IMF, and the hidden financial arteries of Central America. When El Salvador became the first country in the world to adopt Bitcoin as legal tender, the move was celebrated as revolutionary. Financial inclusion, economic sovereignty, freedom from traditional banking. But behind the headlines, another conversation was taking place, a quieter one, inside the offices of the International Monetary Fund. Because while Bitcoin symbolized innovation, the IMF saw something else: risk. Section 1. What the IMF actually objected to. Despite widespread claims online, the IMF has never publicly accused El Salvador of using Bitcoin to support drug cartels. There is no IMF document naming cartels, no allegation of criminal coordination. Instead, the IMF's objections were consistent and technical. They focused on financial integrity, money laundering risk, and systemic transparency. In IMF terms, this is not a crime accusation, it's a stability warning. Section 2. Why Bitcoin triggered alarms. The concern wasn't Bitcoin itself, it was how Bitcoin was implemented. El Salvador did not simply legalize crypto, it state-sponsored it. Through the government-backed Chivo wallet, the Salvadoran state became an active participant in a parallel financial system. From the IMF's perspective, this raised immediate red flags, because systems with limited oversight, unclear reporting, and fragmented records don't need criminal intent to become criminally useful. Section 3. The transparency gap. One issue dominated IMF negotiations: transparency. There was no comprehensive public record of how much Bitcoin the government held when purchases were made, or how public funds were exposed to volatility. In traditional finance, this level of opacity would be unacceptable. In a region with a long history of illicit capital flows, it was considered dangerous. Section 4. When policy met money. By 2024 and 2025, El Salvador was seeking a $1.4 billion IMF loan. At that point, Bitcoin policy stopped being symbolic. It became conditional. The IMF did not demand a ban. It demanded containment. Section 5. The reforms. To move negotiations forward, El Salvador agreed to key changes. Bitcoin acceptance by businesses was made voluntary, and the government committed to strengthening anti-money laundering rules, counter-terrorist financing frameworks, and transaction oversight. These were not ideological concessions, they were structural ones. Why cartels are always part of this story. Here's where the narrative shifts, because the IMF doesn't police crime, but cartels follow financial incentives. They don't need laws changed in their favor. They only need gaps. And in Central America, financial gaps have historically been exploited by organized crime. Central America as a financial bridge. Central America is not just a drug corridor. It's a financial transit zone, a region where dollarized economies, cash-heavy commerce, weak enforcement, and informal banking create ideal laundering conditions. For decades, cartels relied on bulk cash smuggling, shell companies, trade-based money laundering, and real estate investment. But those methods are increasingly monitored, so cartels adapted. Cryptocurrency didn't replace traditional laundering. It supplemented it. It offered speed across borders, fragmentation of transactions, and plausible deniability. Not anonymity, but complexity. And complexity is protection. Why El Salvador was a special case. Most countries regulate crypto privately. El Salvador made it sovereign adjacent. That distinction matters. When the state promotes a wallet, subsidizes transactions, and operates outside traditional banking rails, it creates a gray zone, not illegal, but exploitable. The IMF didn't accuse, it anticipated. Cartel money moves regionally. To understand the concern, follow the money. Drug proceeds are generated in the United States. Production and logistics are concentrated in Mexico. But financial transformation increasingly happens further south. Cartel money flows through Central America before re-entering the global economy, not in bulk, but in fragments. Cartel finance follows a predictable structure. Layer 1, generation, cash created through drug sales. Layer 2, transformation, funds broken down through remittances, exchange houses, crypto wallets, prepaid instruments, and falsified trade invoices. Layer 3, integration. Money reappears as real estate investment, agriculture, construction, tourism, and logistics. Crypto is not the system. It's one tool inside it. The IMF's concern wasn't El Salvador alone. It was replication. If sovereign crypto systems with weak oversight could coexist with international lending, others might follow. And once that happens, tracking illicit finance becomes exponentially harder. This wasn't ideological. It was systemic risk management. Cartels thrive where rules are unclear, not where laws are absent. Unregulated spaces, inconsistent enforcement, incomplete data, innovation that outruns oversight, creates exactly those conditions. This isn't just El Salvador. Cartel money flows through Guatemala, Honduras, Nicaragua, Costa Rica, Panama, and offshore hubs. Wherever scrutiny is weakest, a new node forms. That's why financial integrity is treated as a security issue. The public debate often asks, did Bitcoin enable cartels? The more accurate question is, did it introduce vulnerabilities before safeguards were in place? The IMF answered that question cautiously, with conditions, not condemnation. Cartels will continue to adapt. If crypto tightens, they will shift channels. If banks clamp down, they will fragment flows. If transparency increases, they will exploit volume. Technology changes. The strategy does not. El Salvador's Bitcoin experiment was never just about currency. It became a test case for how financial innovation intersects with illicit economies in fragile regions. The IMF didn't accuse, it warned. Because in the world of cartels, the most dangerous systems aren't illegal, they're unobserved.